Hello, welcome back to UK Money Wisdom. I'm Angie, and today we're doing something that will make pensioner tax feel calmer, clearer and genuinely easier. From this video onwards, every episode in this series will use the same format. We're going to have 3 standard pension tax scenarios and 1 non-standard scenario that catches people out, all using completely fictitious examples, no personal details ever, so you can understand how HMRC rules work in the real world without worrying about privacy. All UK tax details match the 2025-26 rules as we hold them. And each scenario gets progressively more complex because that's exactly how pension taxation works. Once you add savings, small jobs, investments, shares, dividends, and so on. Before we start, you'll notice that I list each person's income in a very specific order. This is because it has to mirror the same hierarchy that HMRC uses when assessing a pensioner's tax position. Because HMRC categorises income types in a predictable sequence. And this sequence affects how PAYE codes are created, which income streams are taxed first, how allowances are applied, and when self-assessment is triggered. So the order is not random. Using HMRC's order means every example matches the real tax logic, so nothing is misleading and every allowance is applied correctly. Let's look first at the HMRC logical order. I hope I've made this easy to understand. HMRC assesses pension income broadly in this order. First, the state pension, then other pensions, then any work income, then savings, dividends, and finally things like share sales or foreign income. Here's a list of them, which will make it easy to understand. First, state pension, which will be taxable but paid gross. It's always assessed first. Number 2, other pensions. These are private pensions, DB, that's defined benefit, drawdown, used for PAYE adjustments. Number 3, employment income, if any, so that's from your job. Number 4, savings income, that's bank interest, for example. 5, dividend income. 6, capital gains or one-off events. And 7, foreign income. This is the cleanest way to teach people how HMRC actually processes income. Now let's apply that to the scenario so you can see the consistency. And let's begin with the simplest case. Here's example 1, the simple starter. Meet Mary, age 67. Her income is state pension, 11,540. We're going to give an example where the state pension is below the full rate. I do know the state pension is over 11,900. No private pension, no savings interest above 5,000, no investments. And Mary's question is, do I need a tax return? And is my state pension taxed? And this is what I would say to Mary. Mary, all state pension is taxable, even though it's paid gross, but her income is below the personal allowance of 12,570, so no tax is due. There are no tax code adjustments and no self-assessments required for Mary. The outcome for Mary, in simple terms, no tax return, no HMRC involvement. This is exactly how HMRC would assess it. State pension first, below personal allowance, no further steps. And I think that is the cleanest, calmest pensioner tax scenario that we will have. Let's look at example 2. And this is a saver who has a small pension. Meet Glen. He's 70, and let's look at his income. As always, in HMRC aligned order. He has a state pension of, let's say, 11,540, and his personal pension drawdown is £3,000, and his savings interest is £700. And Glen's questions are, does savings interest trigger HMRC? Do 2 pensions mean a tax return? So, an explanation for Glen. Let's look at his total income, which is his state pension £11,540 plus £3,000 from his personal pension plus £700 savings interest, which equals £15,240. Now, this exceeds the personal allowance, which is £12,570, as we know. So, tax must be collected, but not from the state pension itself. HMRC instead adjusts the tax code on his private pension, so the right amount is collected automatically. Savings interest of £700 is below the personal savings allowance of £1,000, so no tax return is needed for that either. HMRC will reduce Glen's private pension tax code, collect the tax automatically through PAYE on his private pension, and normally not request a tax return. A simple outcome for Glen: no self-assessment, PSA covers his savings interest, straightforward PAYE collection, and HMRC adjusts the code automatically. This shows how HMRC uses tax codes to handle the state pension, which is a common and very straightforward case. HMRC taxes the private pension through PAYE to collect the tax generated by the state pension being paid untaxed. And savings interest comes after pensions, so the PSA can be applied correctly. Right, now let's move on to scenario 3, the mixed income pensioner. Let's meet Rita, and she's aged 74. Now her income in the HMRC aligned order, she has state pension, again the £11,540 I'm fond of using. Defined benefit pension is £9,800 in her case. Part-time job, she earns £2,300. She has savings interest of £1,600. And finally, she has dividends of £900. Again, why is it in this order for Rita? Well, because first, the HMRC combines all taxable income that runs through PAYE. State pension is assessed. Defined benefit pension and employment are taxed. Then they apply the personal savings allowance to the interest. Then they apply the dividend allowance. If this order is not followed, the allowances can be misapplied, and this happens, which is exactly why many pensioners get wrong tax codes. So always check. Rita's questions are, does this mix of income force a tax return? What about my savings and dividend allowances? Here's a simple explanation. you combine everything like this. Pensions 21,340, job 2,300, savings £1,600, dividends £900. That gives a total of £26,140 income. Now, look at the savings allowance because the first £1,000 is tax-free. So, in her case, £600 would be taxable. And let's look at dividend allowance. The first £500 is tax-free. So, in Rita's case, £400 is taxable. And why is a tax return likely for Rita? Because she has mixed and multiple income types. Dividends and savings interest cannot always be collected fully through PAYE. And there's a higher chance of incorrect tax codes. HMRC often requests a self-assessment for this exact pattern of income. So the outcome for Rita, she should expect a tax return request. There are several small allowances that must be applied in the correct order, and PAYE alone may not collect everything. This is the most common modern pensioner tax situation. In scenario 4, let's look at a non-standard case that trips people up, shall we? Let's meet Tom. Now, he's 66, newly retired. Now, the events this tax year for him are his state pension starts midway through the year. He has a one-off £20,000 UFPLS withdrawal from a SIPP. He has overseas bank interest of £450, shares sold for £45,000, gain unknown. Not many of us will be in this scenario, but it's an interesting one. So, first of all, why have I shown it in this order? Again, HMRC separates regular income from other income, and UFPLS is taxed via PAYE on an emergency code. Foreign income, now that triggers self-assessment automatically. Capital gains, that's only assessed after income tax because the thresholds depend on total taxable income. This is exactly how HMRC decides whether a tax return is compulsory. This matches HMRC's internal process. It makes allowances apply correctly. It makes code adjustments understandable. And it will help you viewers recognise what is taxed first. It helps viewers recognise their own letters, codes and notices. It also prevents confusion about what is taxed first. So I think it creates a consistent learning structure for this whole series. You see, if you showed income in a random order, say dividends first, then state pension, it would mislead people about how HMRC calculates their tax, and it would cause confusion around allowances and make it harder for people to understand their own tax codes. What does Tom specifically want to know? He just wants to know what actually triggers a tax return in his case. Here's where multiple HMRC rules collide. Number 1, the UFPLS withdrawal, that's the £20,000, is always taxed with month 1 emergency tax. To fix it, Tom must either file a tax return or submit Form P55. Number 2, his overseas interest of £450. Any amount of foreign interest normally requires declaring via self-assessment. Thirdly, Tom's shares sold, £45,000 worth. It's below the £50,000 disposal threshold, but if gains exceed £3,000, reporting is required. And number 4, mid-year start pension date. This frequently creates incorrect tax codes and adds confusion. So, in short, the outcome for Tom, yes, Tom must file a tax return because there are multiple triggers, UFPLS, plus foreign interest, plus possible capital gains tax. It's a classic example of a complex but common first-year retirement complexity. So today you've seen the format we're going to use for every video in this series, where I give hopefully a simple pension scenario, then a moderate one, thirdly a mixed income real world example, and fourthly a non-standard case that reveals how HMRC really works. It's going to be all calm, step by step, and fully fictional. No personal details ever disclosed. If you'd like me to build a scenario that roughly matches your situation, just give approximate details in the comments and I'll include it in a future video. Please bear in mind that I only offer general guidance based on current UK tax rules and public statements, and it's for 2025-26. I do hope you found this first video in the series useful and the layout useful. Please give me feedback on anything in it, the examples, what you would like me to cover, and whether you'd like me to go into more detail in any way whatsoever, and I'll certainly take that on board. Please keep those comments coming. I love to examine something a little bit different, or just know that I'm helping you. And you will find a general guide as a PDF in the description below. I hope you'll find that useful as well. Please subscribe to make sure that you get the next video. Do share with anyone who might need this advice, and like the video. That will all help to keep the series going. All it remains is for me to say I'm Angie and this is UK Money Wisdom, and I'll see you all again very soon. Enjoy the day. Goodbye for now.